del día.
Y como decimos, ponemos ya la mirada en el análisis internacional. Vamos a aprovechar para hacer un repaso de las últimas referencias que tenemos, sobre todo mirando a Estados Unidos, referencias macro, pero también referencias de política monetaria. Y lo hacemos con BRIAN VENDIG, presidente de MJP WEALTH ADVISORS. BRIAN, thank you so much for having us a few minutes. Good afternoon from Spain.
Thank you. Good afternoon.
Well, BRIAN, today we have some references, but one of them is this US jobs report that showed an increase of 517,000 in January, crushing estimates. Unemployment rate hits 54-year low. Biden has talked in these last minutes, and he said with pride that he was right when he said that it wasn't necessary to see a worse labor market for prices to stop rising so strongly. What do you think about it?
Sure, no, I appreciate that. The jobs report definitely came in well above expectations to show that the U.S. economy has been extremely resilient in light of the Federal Reserve increasing interest rates, trying to slow demand throughout the economy. And what we've seen from today's jobs report is an unemployment rate that ticked down to about 3.4% from 3.5 in the previous report. And we've seen really strong gains coming from the service sector of the economy, which is about 70% of the US economy, as a friendly reminder. And we saw that this job growth came in light of layoffs that we've seen consistently announced from the tech sector over the last several months. So I think really what this means from an investing point of view and a setup, at least for the next couple of months, is that Federal Reserve probably feels like they still have more work to do, which this report resonates what Powell said just the other day this week when the Federal Reserve increased interest rates up by 0.25% to a rate now that stands between 4.5 and 4.75. And most likely what we're seeing is that we did see a slight uptick in participation rate, and that wage growth has been moderating, which is a good sign from an inflation point of view. But I think it pretty much confirms that the Fed will continue to stay on a path of increasing interest rates for at least the next two policy decisions before they take a step back and pause to give a little bit more time for their policies to play through the US economy. So initial reaction to this report was not favorable in the stock market, because I think the stock market and investors are trying to be optimistic about the Fed taking a step back from rates sooner than later. But our view is that the Fed will be consistent and deliberate on this path. And I think today's jobs report confirmed that as we move forward over the balance of the year.
Well, you mentioned Powell. Does this labor data mean that the Federal Reserve will rise interest rates stronger than thought before?
I don't see the Fed wanting to increase interest rates stronger than the most recent announcement, on February 1st from Chairman Powell. I think the fact that we've really seen inflation come down quite significantly in a reasonable period of time. I mean, if you think back to last year, headline inflation was at 9.1%. We ended the year at around 6.5 headline. Core inflation being under 6. That is some progress, and I think what we're dealing with right now is that inflation is continuing to stay elevated in the service sector, which is really primarily impacted by demand. Wages are moderating, and I still think we need a little bit more time to see some data on housing and rent. So we expect that the Fed will continue to increase rates at this 25 basis point level unless something comes out of the CPI or inflation data over the next couple of weeks or months that gives the risk that inflation is ticking up again. So I think as of right now, it stay the course based on expectations. But I think it's fair to assume that with a strong labor market, and if this labor market continues to be tight over the course of the year, I don't think the Federal Reserve is going to cut interest rates as the market expects in 2023, We expect the Fed to hold at these levels, slightly increase a little bit as we move forward over the next couple of months, and not really think about cutting interest rates until we get to sometime next year, which again, if we have more jobs reports like today, we'll probably echo those points moving forward.
And Brian, we are still analyzing some Powell remarks from this Wednesday. He considers that the disinflationary process has started in the US. What does it mean for the US economy, and what does it mean for markets?
Definitely, and that's a great question. I think for the US economy, continuing to try to slow down the economy increases the probability of some sort of economic slowdown happening this year. Probably a greater than 50% probability, because we've seen consumer spending starting to slow. We've seen contraction in the manufacturing and services sector. So the indicators say that the economy is slowing and the Federal Reserve's policies are working and lowering inflation. I think the risk is that the Fed overshoots while the economy is naturally slowing, and potentially drives the economy into a deeper economic recession or slowdown. So we think that these policies probably will work to some sort of economic slowdown this year. It's questionable if the government will declare a recession or not, as we've seen in last year's numbers that did not occur. And I think from an investing perspective, you have to look at things a little differently between bonds versus stocks. I think last year bonds really took it on the chin from interest rates increasing quite significantly and very quickly, which we haven't seen for almost 40 years. And I think right now bonds look pretty fairly attractive. So I think as the economy's slow, longer term interest rates should go down, which would be favorable to fixed income. I think on the equity side, it's really more about earnings this year. We've kind of been indoctrinated with what the Fed is going to say, but I think investors are coming back to the fundamentals and coming back to profits and expectations of valuation on future cash flows. So I think on the equity side of the house, we have to be a little bit more patient for the market to come back, but we are optimistic that as we move through this economic slowdown, that will give a signal to investors that a majority of the bad news is priced in. And we think that possibly later on this year and definitely next year will be a more robust investing environment from an equity perspective. So stay cautious in the short term, be realistic about some of the risks that are out there from a valuation point of view. But I think longer term, be optimistic and that there might be some more good news to come from a longer term investing point of view.
Brian, how do you see the ISM services that we knew today? Because it's remarkable that we passed from contraction to expansion. Now it's 55.2%, and it's remarkable. It's really significant because we saw how in December this data showed a contraction for the first time in 30 months, and in this case it showed an expansion again. So which is the interpretation that we must do from this data?
Yeah, I think a lot of this data, that's a great question. A lot of this data is very mixed. And I think at different points in time, depending on what's going on in the global economy as well as what's happening in the domestic economy in the US, might give you a false narrative on exactly what's happening in the underlying economy. So with a contradictory services number that went from contraction to expansion, I think it's because you look under some of the different sectors in the economy that get a jump start at different points in time in the year. So for example, seeing expansion in the healthcare services sector, at different points in time can influence those services numbers versus maybe a contraction in another area of the services economy. So I think that what the service data says, which is echoed by the wage data that we saw today in the jobs report and just the jobs market overall, is that the economy is a lot more resilient than maybe the Fed expects. And maybe some of the ways that we measure economic output needs to be revised in this COVID-affected world, and in a world where supply chains are also impacted by countries opening and closing relative to COVID as well. So I think we need to keep a close eye on the data. That's the best that we can do. But I think, you know, seeing expansions in the services sector is not necessarily what the Fed and others were hoping for, and that I think we should expect that inflation over the course of the year will come down. The economy will continue to slow from Fed policy, but having these type of services numbers will probably keep inflation elevated and above that 2% target that the Fed is hoping for us to get to, and probably unrealistic for us to reach in 2023.
Much for having us these few minutes, and a pleasure as always. Good weekend.
Thank you. Have a great weekend.
Pues nosotros nos